How to amortize lease payments. If you are a small business owner and you are curious about how to handle lease payments, you are in the right spot. Understanding how to amortize lease payments can help you manage your finances better and maximize your tax deductions. Let's break it down step by step. First, you need to identify the type of lease you have. There are two main types: operating leases and finance leases. An operating lease means you do not own the asset. In this case, you can usually deduct the lease payments as rental expenses. On the other hand, a finance lease treats you as the owner for tax purposes. This allows you to claim depreciation on the asset and deduct interest expenses on the lease liability. Next, let's talk about accounting standards. Under the generally accepted accounting principles, also known as GAAP, specifically the Accounting Standards Codification number 142, you must recognize a right-of-use asset and a corresponding lease liability on your balance sheet if your lease lasts longer than 12 months. The lease liability is measured as the present value of your lease payments. The right-of-use asset is equal to the lease liability adjusted for any initial direct costs, lease incentives, and prepayments. Now, how do you actually amortize these payments? For finance leases, you generally amortize the right-of-use asset on a straight-line basis over the lease term or the useful life of the asset if ownership transfers. For operating leases, you recognize the lease expense on a straight-line basis over the lease term, even if your payments vary. When it comes to tax treatment, lease payments for a true lease, which is an operating lease, are usually deductible as rental expenses when paid. This means you can deduct them based on your payment schedule. For finance leases, you will not deduct lease payments as rent. Instead, you will claim depreciation on the asset and deduct interest on the lease liability. It is also important to reconcile your book and tax treatment. Since accounting standards requiring you to recognize lease expenses on a straight-line basis or separate interest and amortization, while tax rules allow deductions based on actual payments, you may face timing differences. This could mean tracking deferred rent or lease-related timing differences for tax compliance. For small businesses, here are some practical steps to follow. First, review your lease agreement to classify it correctly. Next, record the lease liability and right-of-use asset at the start of the lease for accounting purposes. Then, amortize the right-of-use asset and recognize interest expense on the lease liability according to the Accounting Standards Codification number 142. For your tax filings, deduct lease payments as rent if it is a true lease. If it is a finance lease, use depreciation and interest deductions instead. By following these guidelines, you can effectively manage your lease payments and ensure compliance with both accounting and tax regulations. Understanding these processes can help you make informed decisions for your small business.